Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZJLD Group Inc. Annual Report. ZJLD Group Inc. is a Chinese company that specializes in the production and sale of baijiu products. The company offers a range of baijiu products with different aromas, including sauce aroma, mixed aroma, and strong aroma. These products are sold under various brands such as Zhenjiu, Lidu, Xiangjiao, Kaikuzayo, and Shaoyang. The company has established a multi-channel sales strategy to reach its customers. It sells its products through distribution and store partners, retailers, and direct sales force, as well as through online stores. This approach allows the company to cater to different customer segments and preferences. In addition to its core business of baijiu production and sale, ZJLD Group Inc. operates as a subsidiary of Jindong Investment Group Co., Ltd. The company's headquarters is located in Beijing, China, and it has been in operation since 1975. ZJLD Group Inc. market capitalization of 30 billion is significantly larger than the average industry peer of roughly 0 billion. This shows that ZJLD Group Inc. holds a significant advantage in their industry. ZJLD Group Inc. trades at a higher price-to-earnings ratio of 47 times and a higher price-to-book ratio of 1.91 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be attributed to various factors. On the growth side, the introduction of new product series, expansion of geographic reach, strong brand positioning, and launch of new products have contributed significantly to revenue growth. The company's premium brand image and unique immersive marketing approach have also played a crucial role in driving sales. Furthermore, the relaunching of upgraded baijiu products, continuous elevation of product quality, and reinforcement of brand competitiveness within the target market have all contributed to revenue growth. Additionally, industry-academia research cooperation, expansion of production capacity, increase in base liquor inventory, and growing demand for premium and above baijiu products have also driven sales. On the decline side, weakened consumption demand due to anti-graft policies, decrease in market demand for baijiu, and reduced spending on baijiu for business, social banquets, and gifting occasions have all contributed to revenue decline. The company's measures to reduce channel inventories have partially offset these declines. The decline in sales volume and average selling price for Zhenjiu brand, decreased revenue from Lidu and Xiangjiao brands, and revenue decline from Kaikuzayo due to softened demand and intense competition have also contributed to the overall decline. The premium baijiu products saw a significant decline of -47.3%, while mid-range and below baijiu products declined by -42.5%. Distributors experienced a decline of -51.4% due to online channel development, while direct sales declined by -21.3% due to the decline in business banquet, gifting, and other occasions. The net income of the company underwent significant fluctuations over the 2-year period. Initially, it decreased by 20.4% due to weakened consumption demand. However, this trend was reversed with a notable increase in FY 2025, driven by strategic partnerships such as the one with China Unicom and the implementation of AI-powered frameworks. This led to an impressive 68.8% growth from FY 2024 to FY 2025. The profit margins also experienced changes during this period. The net profit margin decreased by 21.9%, while the adjusted net profit margin dropped by a more substantial 29.4%. However, certain segments showed improvement due to cost-saving measures, such as robotic process automation, RPA. For instance, premium price range saw an increase of 2.8 percentage points in profit margins, and mid-range and below price range experienced a 1.3 percentage point rise. The reasons behind these changes are multifaceted. Weakened consumption demand was a major factor contributing to the initial decline in net income. However, strategic partnerships and cost-saving measures helped mitigate this impact. The company's efforts to reduce cross-regional selling and price disruption risks also contributed to improved profit margins for certain segments. Overall, while there were fluctuations in net income and profit margins, the company demonstrated resilience and adaptability in response to changing market conditions. The company's financial performance reveals a concerning trend. Despite various statements, the evidence suggests that the company is actually experiencing negative operating cash flow. The figure of RM 885.6 million under net cash, used in / generated from operating activities, on page 1 confirms this assertion. This indicates that the company is utilizing more cash than it generates from its operations, resulting in a net outflow of funds. The contradictory statements found on pages 26 and 33 only add to the confusion. However, they do not alter the fact that the company's operating activities are consuming more cash than they produce. The absence of any information on page 29 further underscores the lack of clarity surrounding the company's financial situation. Ultimately, the data presented paints a picture of a company struggling with its cash flow management. The company's debt level has experienced significant growth over the past year. According to financial reports, bank and other borrowings increased by 87.1% from RMB 510.2 million to RMB 953.6 million. Additionally, bills payables also saw a substantial rise, increasing from RMB 962,325 in 2024 to RMB 1,884,470 in 2025. The increase in debt has led to a substantial rise in interest expenses for the company. Interest expenses have increased by 165% from RMB 12.9 million to RMB 33 million, indicating a significant burden on the company's finances. This sharp increase in interest expenses is likely due to the higher debt levels and may pose challenges for the company's financial stability going forward. The performance of various segments within the company has been mixed. On one hand, the Li Du, Xiangjiao, Kaiku Zio, and other segments have all experienced a decline in revenue over the past year. Specifically, Li Du's revenue decreased by RMB 227,487, while Xiangjiao saw a drop of RMB 334,177. The Kaiku Zio segment suffered an even more significant decrease of RMB 235,109, and others' revenue plummeted by RMB 61,169. In stark contrast, the Zhenjiu segment has shown remarkable growth, with its revenue increasing by RMB 1,597,617 over the same period. This significant uptick in revenue is a testament to the segment's resilience and adaptability in the face of changing market conditions. Overall, while some segments have struggled, others have demonstrated their ability to thrive and drive business forward. Management's outlook on the company's future. The company's management has provided insight into their outlook and strategy for the company's future. One key point is that the decline in revenue is impacting the company's overall outlook, indicating a need to address this issue. To mitigate this, management intends to fund future capital expenditures using available financial resources, suggesting a focus on cost management and efficient use of funds. In addition to addressing the revenue decline, management has also highlighted their commitment to managing foreign exchange risk. They will continue to monitor and mitigate this risk, demonstrating a proactive approach to managing potential threats to the company's financial stability. Overall, these statements suggest that management is focused on navigating the current challenges facing the company while positioning it for long-term success. The company's financial history reveals a consistent trend of dividend payments. According to page 40, the company has paid dividends for 2 consecutive years, 2024 and 2023. The amounts paid out in these years were RMB 652,134 and RMB 556,691, respectively. This indicates that the company prioritizes returning value to its shareholders through dividend payments rather than other means such as share buybacks. Concerns about inventory buildup are evident in the recent market trends. Efforts have been made to alleviate distributor pressure by reducing inventory levels, particularly through accelerated reductions in the second half of 2025. However, despite these efforts, concerns persist regarding inventory buildup. The data suggests that inventory levels across all categories have increased, including raw materials, work in progress and maturing inventories, and finished goods. This is further exacerbated by potential overstocking or inventory buildup in traditional distribution channels due to decreased revenue from distributors. The adoption of measures to reduce channel inventories of certain deluxe products also indicates a problem with inventory buildup. The issue of inventory buildup appears to be a pressing concern, with multiple factors contributing to the problem. While supply chain disruption is not explicitly mentioned as a concern, the accumulation of excess inventory can have significant implications for businesses and the overall market. That concludes the financial summary for ZJLD Group Inc. Feel free to comment below, and I will be happy to answer them when possible.